Let me tell you about the worst kind of loss in trading. It is not the loss where you are wrong. That one hurts, but it makes sense. You misread the chart, you ignored a level, you got emotional. You can point to the mistake and say, I will not do that again. It closes clean. The worst loss is the one where you are right. Right about the direction, right about the level, right about the timing. You see the move before it happens. You feel it in your chest. Everything lines up. The structure, the momentum, the news, the flow. And you take the trade. And the trade does exactly what you said it would do. But you are not in it anymore because you were liquidated 30 minutes before the move. That is what happened to Marcus on a Wednesday in November. Marcus does not trade like most people. Most retail traders stare at 15-minute charts and chase momentum. Marcus does not. He reads order flow. He watches the depth of the book, the way limit orders stack and thin out at certain levels, the speed at which bids are pulled when price approaches. He has been doing this for 2 years. Not 2 years of watching YouTube, 2 years of screen time, 8 hours a day, 5 days a week, journaling every trade, reviewing every session. He can feel when the market is about to move before it prints on the chart, and today he feels it. Gold has been grinding sideways in a $40 range for 6 days. Most traders see a range. Marcus sees compression. He watches the resting orders above and below and notices something. The sellers above 1,762 keep thinning. Every time price approaches that level, the limit orders that were there yesterday are not there today. Someone is pulling their offers. The ceiling is weakening. He marks it in his journal. Offers above 1,962 drying up, compression pattern. If buyers push through, there is nothing above until 1,990, expecting a hard breakout north. He is exactly right about all of it. Here is what he does next, and here is where everything falls apart. Marcus's account is $12,000. His normal position size is 2 lots on gold, roughly $16 per pip. A solid trade at that size might make him $300, $400. A bad one costs him $150, clean, manageable. But today is not a normal trade. Today, Marcus is certain, not I like this setup certain, not the risk reward is good certain. He is certain in the way you are certain when everything you have learned for 2 years suddenly converges on a single point. The order flow, the compression, the thinning offers, the timing. So he sizes up, not a little. He goes to 8 lots, $64 per pip, 5 times his normal size. His reasoning is precise, logical, calculated. He has a tight stop, 22 pips below the consolidation range. If he is wrong, he loses $1,400. That is 11% of his account. Aggressive, but not insane. The expected move is 80 pips to the upside. That is over $5,000. Risk to reward of almost 4 to 1. On paper, this is the best trade he has ever taken. He enters at 1,958, stop at 1,936, target at 2,038, 8 lots. He checks it twice, he writes it in his journal, he pushes back from the desk and crosses his arms and watches. For 17 minutes, nothing happens. Then gold drops 9 pips. Fast. Marcus does not flinch. 9 pips is nothing. He has a 22 pip stop. This is noise. He expected a shakeout before the breakout. This is what compression does. It traps people on both sides before the real move. Gold drops another 6 pips, 15 below his entry now. He is down $960 in less than 4 minutes. At his normal size, that would be 240. Uncomfortable, but manageable. At this size, it is physical. His hands are cold, his jaw is locked, he can feel his pulse in his neck. But he does not close. The thesis has not changed. The order flow still shows thinning offers above 1,962. The sellers are still pulling back. The structure is intact. Gold drops another 4 pips, 19 below entry, 3 pips from his stop. He is staring at an unrealized loss of $1,216. And now something happens in his brain that does not happen at normal size. At 2 lots, a drawdown is information. It tells you where the market is, how price is behaving, whether your thesis is holding. You can think clearly because the number on the screen is uncomfortable but not threatening. At 8 lots, a drawdown is not information. It is a countdown. Every pip is $64. Every second the trade stays red, the number grows, and the number is no longer data. It is damage. Your brain stops processing the chart. It starts processing the loss. How much have I lost? How much more can I lose? What happens if the stop gets hit? Marcus is no longer analyzing order flow. He is watching a number. Gold ticks down one more pip, 20 below entry, 2 pips from his stop, down $1,280. His hand moves to the mouse. He closes the trade manually, 1 pip above his stop. He sits back. He exhales. He just took a $1,200 loss, 10% of his account, on a trade he was right about. 43 minutes later, gold breaks above 1,962, exactly where he said it would. The offers above the level were gone, just like he mapped. Price rips to 1,988 in 90 minutes, 26 pips past his entry. The move he predicted, the exact move to the tick, plays out perfectly. At his planned 8 lots, that would have been $5,120. He watches it happen from the sidelines with a $1,200 hole in his account. This is not a story about a bad stop loss. His stop was fine. 22 pips below consolidation, technically placed, logically sound. This is not a story about a wrong analysis. His analysis was perfect, better than perfect. It was predictive. This is a story about what happens to a human brain when the position size exceeds the threshold where you can think clearly. Every trader has a number, a size where the trade stops being a trade and starts being a threat. Below that number, you can sit through drawdowns. You can watch price move against you and assess whether the thesis is still valid. You can let the stop do its job. Above that number, the drawdown becomes louder than the analysis. The loss becomes louder than the chart. Your nervous system takes over and makes one demand: make it stop. Marcus closed 1 pip above his stop, not because his thesis changed, not because the chart told him to. He closed because his body could not hold the position anymore. $1,200 of unrealized loss at 8 lots felt like a physical emergency. The same drawdown at 2 lots, $300, would have been a footnote. He would not have even uncrossed his arms. The size changed everything. Not the trade, not the market, not the analysis, the size. Marcus makes this mistake again. Not the same week, not even the same month. But 6 weeks later, he finds another setup that feels like a certainty. Oil this time, same compression, same thinning orders, same feeling in his chest. He sizes up to 6 lots, not 8. He learned from last time. He is managing his risk better. The stop is tighter. The math is reasonable. Oil shakes him out in 12 minutes, then moves 40 pips in his direction. He stares at the chart and says the same thing every overleveraged trader says: I was right. And he was. He was right both times. That is what makes this so dangerous, because when you are wrong and you lose, you learn not to do that. When you are right and you lose, you learn nothing, except that maybe you should have held longer. Maybe the stop was too tight. Maybe next time you will give it more room. You never look at the size, because the size felt justified. The size was based on conviction, and the conviction was correct. But conviction and position size operate on different systems. Conviction is intellectual. You built it from data, from experience, from pattern recognition. It lives in the analytical part of your brain. Position size is physical. It lives in your nervous system, your adrenal response, your tolerance for pain. And your nervous system does not care how good your analysis is. It cares how much you stand to lose. You cannot override biology with a chart. There is a calculation that Marcus, and most traders, have never done. Not the risk to reward ratio, not the win rate, not the Kelly criterion or any formula from a textbook. The calculation is this: what is the maximum drawdown I can experience on this trade and still think clearly? Not the maximum drawdown I can afford, not the maximum drawdown my account can survive, the maximum drawdown where I can look at the red number on the screen and still calmly assess whether the thesis is intact. For Marcus, at 2 lots, that number is somewhere around $300. He has sat through $300 drawdowns dozens of times. He is calm. He reads the chart. He lets the stop work or the trade work. No panic, no early exits. At 8 lots, the equivalent drawdown in pips hits $1,200 before the trade has even breathed. His pain threshold is crossed in the first 4 minutes. Everything after that is survival mode, not trading mode. The math was never wrong. The analysis was never wrong. The size was wrong. Not wrong by the textbook, wrong by the body. Marcus figures this out in January. Not from a course, not from a mentor, from a spreadsheet. He exports 3 months of trades and adds 1 column, position size. Then he color codes the outcomes. Green for winners held to target. Yellow for winners closed early. Red for losers closed before the stop. The pattern is immediate. At 1 to 2 lots, nearly every trade runs its course. Win or lose, the trade plays out as planned. The stop gets hit or the target gets hit clean. At 4 lots and above, over 70% of trades are closed early, most of them before the stop is reached. Many of them went on to hit the target after he was out. He was not a worse trader at higher size. He was the same trader with a different nervous system. The analysis did not degrade. His ability to sit in the trade did. He prints the spreadsheet. He circles the column. He writes 1 line at the bottom. The edge is not the analysis. The edge is staying in the trade long enough for the analysis to work. Marcus trades 2 lots now. He makes less per trade than he imagined he would when he sized up. His best month at 2 lots is about what 1 good trade at 8 lots would have been, and some part of him. The part that remembers being right about gold, right about oil, right about the move before it happened, that part still whispers, "You are leaving money on the table." But he has seen the spreadsheet. He knows what happens when he listens to that voice. He is right about the trade and wrong about the size, and being wrong about the size turns right into loss. He does not size up anymore, not for conviction, not for compression, not for the trade of the year. He lets every trade breathe. He lets every stop do its job. And the trades that would have shaken him out at 8 lots, the ones that dip 20 pips before ripping 80, those are his biggest winners now. Not because the setup changed, because he can sit through them. The analysis was never the problem. The problem was always what happened between the entry and the exit, and what happens there is not controlled by the chart. It is controlled by the size. The best traders do not size up when they are certain. They size up when they can afford to be wrong at that size and still think straight. Marcus was right about the trade. He was right about the direction, the timing, the level, and the move. He was wrong about 1 number, and that 1 number turned the best trade of his life into a $1,200 lesson. Position size is not a math problem. It is a psychology problem. And the answer is not the number your account can survive. It is the number your nervous system can survive. If you cannot sit through the drawdown, the size is wrong, no matter what the chart says.